They buried the report, not figuratively, not metaphorically. I'm not being dramatic for the sake of a thumbnail. I mean that a research document containing the most important supply data in the history of the silver market was completed, reviewed, stamped, and then deliberately withheld from public distribution by the very institution that commissioned it. For years, we have sat here on this channel and talked about deficits. We have pulled the COMEX data. We have tracked the LBMA vault drawdowns ounce by ounce. We have watched the registered inventory bleed dry month after month, and we have said the same thing over and over again. The math does not work. The supply is not there. Something is going to break. We have said it so many times that some of you stopped believing it. I know because I read your comments. I see the fatigue. I see the frustration. People saying the deficit narrative is overblown. People saying if there was really a shortage, the price would already be at $100. People telling me I am crying wolf. I understand that frustration. I felt it too. Because up until 72 hours ago, we were working with incomplete data. We had the demand estimates. We had the mine supply numbers. We had the recycling inputs. But we were missing one critical variable, one number that changes everything. We are not missing it anymore. The wolf is here, and it is not at the door. It is already inside the house. Ladies and gentlemen, this is the market cipher. What I'm about to show you today is the most consequential piece of silver market research I have ever covered on this channel. It is the reason I have not uploaded in 4 days. I needed to verify every number. I needed to cross-reference every data point. Because what this document reveals is so severe, so structurally devastating to the global silver supply chain, that if the market fully prices in what I'm about to tell you, the current spot price of silver will look like a rounding error. 300 million ounces. That is the number. That is the size of the cumulative supply gap that will have opened up by the end of 2026, according to the internal modeling that was never supposed to reach public hands. And today, I'm going to walk you through every single line of that model, show you exactly how the number was derived, explain why it was buried, and tell you precisely what it means for every ounce of silver you own and every ounce you should own, but do not yet. Let us begin with the document itself, because the provenance matters. Where data comes from determines whether you should trust it. And the source of this data is not some anonymous blog post. It is not a Reddit thread. It is not a newsletter writer selling you a subscription. The data originates from an internal supply chain risk assessment prepared for a consortium of industrial consumers. I'm not going to name the specific consortium because the person who shared the document with our research team did so at significant professional risk. But I will tell you the caliber of the entities involved. We are talking about companies that consume silver in quantities measured in tens of millions of ounces per year. Solar panel manufacturers, semiconductor fabricators, defense contractors. These are not speculators. These are not silver bugs. These are procurement officers whose job is to secure physical supply for manufacturing lines that cannot stop. The assessment was completed in the 3rd week of last month. It was prepared by one of the top 3 commodity consultancies in the world, a firm whose name you would recognize instantly if I said it. The methodology is rigorous. The data inputs are sourced from mine operator filings, customs manifests, refinery throughput reporting, and satellite verified production estimates. The document runs 47 pages. I have read every single one of them. And the conclusion on page 43 is stated in language so stark that it reads like a warning label on a bottle of poison. Under current demand trajectories and confirmed supply pipelines, the cumulative structural deficit in the global silver market will reach approximately 300 million ounces by the 4th quarter of 2026. This deficit cannot be bridged by recycling, inventory drawdowns, or anticipated mine production. A physical supply crisis of this magnitude has no historical precedent in the modern era. 300 million ounces. Let me put that number in a context you can feel. 300 million ounces is equivalent to roughly 36% of an entire year of global mine production. It is more silver than currently sits in every COMEX vault combined. It is more than 3 times the total holdings of the SLV ETF. It is a volume of metal that literally does not exist above ground in available form. This is not a projection based on wild assumptions. This is not a moonshot fantasy. This is a procurement risk assessment prepared for industrial buyers who need to know whether they can keep their factories running. They do not care about your portfolio. They do not care about the silver squeeze narrative. They care about one thing: can we get the metal? And the answer from this report is no, not at these prices, not at any price that the current market is contemplating. Think of it like this. The silver market is a bathtub. Every year the mines pour roughly 820 million ounces of water into the tub. Every year, industry and investment drain roughly 1 billion ounces out. The tub has been losing water for 4 consecutive years. Nobody fixed the drain, nobody turned up the faucet, and now someone has finally measured the water level and discovered that the tub is about to run dry. But that is the polite version, the version the consultancy put in the executive summary. The version designed to be alarming enough to motivate action without being so terrifying that it triggers panic buying from the very clients who commissioned it. The detailed model underneath tells a darker story, and that is the story I'm going to walk you through today. Now, the first question you should ask is why? Why is 300 million ounces going to disappear by 2026? Is it because demand is growing? Yes. Is it because supply is shrinking? Yes. But neither of those answers alone explains the magnitude of what is coming. The real answer is that both things are happening simultaneously in a way that has never occurred before in the history of this metal. Let me take you through the supply side first, because this is where the mainstream narrative falls apart completely. Global silver mine production peaked in 2016 at approximately 900 million ounces. Last year it came in at roughly 820 million ounces. That is a decline of nearly 9% over 8 years. But it is not a straight line decline. It is an accelerating curve. The drop from 2023 to 2024 alone was 3.5%. The preliminary data for the first half of this year suggests the decline is steepening further. Why? Because nobody built new silver mines. It is that simple and that devastating. The average timeline to bring a new primary silver mine from discovery to production is 13 to 18 years. That is not a typo. 13 to 18 years. You have to find the deposit. You have to drill it. You have to conduct a feasibility study. You have to obtain environmental permits. You have to fight the lawsuits from local communities and environmental groups. You have to secure financing. You have to build the infrastructure. You have to hire and train the workforce. And then you have to actually start pulling rock out of the ground and processing it. There is not a single major primary silver mine under construction anywhere in the world right now that will produce its first ounce before 2028. Not one. The pipeline is empty. The permitting backlog is measured in years. The capital investment required is measured in billions. And the political risk in the jurisdictions where silver deposits exist, Mexico, Peru, Bolivia, Argentina, is at historic highs. So the supply is declining and it is not coming back. That is the first jaw of the trap. Now let us look at the demand side, because this is where the report gets genuinely terrifying. Silver industrial demand hit a record of approximately 680 million ounces last year. That number has been climbing relentlessly for 6 consecutive years. But the rate of climb is about to go vertical because of 3 simultaneous structural forces that are not cyclical, are not optional, and cannot be reversed by any government policy short of abandoning the global energy transition entirely. Force number 1, solar photovoltaics. A single gigawatt of solar panel manufacturing capacity consumes approximately 800,000 ounces of silver. The world installed 450 gigawatts of solar capacity last year. The International Energy Agency projects that number will reach 650 gigawatts by 2026. That is a 44% increase in solar installations in just 2 years. Run the multiplication. 650 gigawatts times 800,000 ounces is 520 million ounces of silver just for solar. That single application will consume 63% of total mine supply by 2026 for one use case out of hundreds. Force number 2, electric vehicles and power electronics. Every electric vehicle contains between 1 and 2 ounces of silver in its electrical contacts, battery management systems, and charging infrastructure. Global EV production is projected to reach 30 million units by 2026. That is 40 to 60 million ounces. But the bigger number is the charging infrastructure. Level 3 DC fast chargers contain up to 6 ounces of silver per unit. The US alone has mandated 500,000 new chargers by 2030. Multiply globally, and you add another 25 to 40 million ounces of demand that did not exist 3 years ago. Force number 3, military and advanced electronics. This is the demand category that nobody talks about because the data is classified. Silver is a critical component in every cruise missile, every radar system, every satellite, every advanced weapons platform. Global defense spending hit $2.4 trillion last year, the highest in human history. Every dollar of that spending drives demand for the strategic metals that make modern weapons function. Silver is at the top of that list because no other element conducts electricity and heat as efficiently while resisting corrosion in extreme environments. Now add it up. Solar alone will demand 520 million ounces by 2026. EVs and charging add 80 to 100 million. Military and advanced electronics add another 60 to 80 million. Photography, medicine, brazing alloys, and other traditional uses account for approximately 180 million ounces that have remained remarkably stable. Total industrial demand by 2026, approximately 840 to 880 million ounces, against mine supply of 780 to 800 million ounces, which is the optimistic scenario that assumes no further production declines. The industrial deficit alone, before a single investor buys a single coin or bar, is 60 to 100 million ounces per year. But investment demand is not zero. Investment demand has averaged 250 million ounces per year for the last 4 years. Even if investment demand drops by half, and there is no indication it will, you add another 125 million ounces to the annual shortfall. Total annual deficit by 2026, approximately 185 to 225 million ounces per year. Accumulate that across the 2024 to 2026 window, and you arrive at the report's headline number, 300 million ounces. That is where the number comes from. It is not a guess, it is arithmetic, it is the subtraction of known supply from documented demand trajectories. And it is conservative, because the model does not include any demand surge from a monetary crisis, a currency devaluation event, or a retail buying panic. It assumes orderly markets. It assumes no geopolitical disruptions to mine supply. It assumes no acceleration in the energy transition beyond what is already legislated and funded. If any of those assumptions break, and several of them are already breaking, the 300 million ounce figure is the floor, not the ceiling. Do the math one more time. Let it settle. 820 million ounces coming in, over 1 billion going out every single year for 3 consecutive years. Where does the difference come from? It comes from the inventories. It comes from the vaults. It comes from the stockpiles that were built up over decades of surplus production that ended in 2021 and are never coming back. The COMEX registered inventory, the metal that is actually available for delivery against futures contracts, has dropped from over 150 million ounces in early 2021 to approximately 30 million ounces today. That is an 80% drawdown in 4 years. The LBMA vault holdings in London have declined by over 200 million ounces since their peak. The silver is physically leaving the Western vault system. The SLV ETF, which is supposed to hold physical silver backing every share, has seen its holdings decline by over 40% from peak levels, even as the share price has risen. Think about what that means. The price is going up while the metal is going out. That is not how an honestly managed ETF is supposed to function. The inventories are not being replenished. They are being consumed. They are bridging the deficit that the mine supply cannot cover. And when those inventories reach zero, and at the current rate of drawdown they reach zero sometime in late 2026, the market does not gently adjust. It fractures. Because you have to understand what happens when a physical commodity market runs out of deliverable inventory. This is not like a stock going to zero. This is not a financial event. It is an industrial catastrophe. When a solar panel manufacturer cannot get silver, they do not shrug and find an alternative. There is no alternative. Silver has the highest electrical conductivity of any element on the periodic table. It has the highest thermal conductivity. It has the highest reflectivity. The physics of photovoltaic energy conversion require silver. You cannot substitute copper. You cannot substitute aluminum. The electrons do not care about your supply chain problems. They care about atomic structure, and atomic structure does not negotiate. When a defense contractor cannot get silver for the guidance system of a cruise missile, they do not ship the missile without the guidance system. The production line stops. The contract is delayed. The national security implication triggers emergency procurement protocols that override market pricing entirely. This is the point that the financial analysts on television fundamentally do not understand. They model silver like a financial asset with substitution elasticity. They assume that if the price rises high enough, demand will fall. And for jewelry, yes, that is true. If silver hits $100 an ounce, fewer people buy silver earrings. But jewelry is less than 15% of total demand. The other 85% is industrial, and industrial demand is what economists call price inelastic. It does not decline when price rises because the cost of silver in the finished product is a fraction of a percent. A solar panel costs $200. The silver in it costs $3. If silver doubles, the silver cost becomes $6. That is a 1.5% increase in the total panel cost. No manufacturer is going to redesign their entire production process, retool their factory, and requalify a new material to save 1.5%. They just pay the higher price and pass it through. This means that silver demand will continue to grow even as the price rises. It is the textbook definition of inelastic demand meeting constrained supply, and the report explicitly models this dynamic through 2026. The conclusion is unambiguous. The price must rise dramatically to ration the marginal units of demand, and even then, the structural deficit persists, because the core industrial demand cannot be rationed at any price. Now I need you to hear what I'm about to say next, because this is the part where the report transitions from alarming to enraging. This data exists. The industrial consumers have it. The major banks have it. The commodity consultancies have it. And not one of them has published it. Not one. The Silver Institute's annual World Silver Survey, the document that every analyst on Wall Street cites when they discuss the silver market, projects a deficit for this year of approximately 150 million ounces. That is the public number. That is the number that gets printed in the research notes. That is the number that CNBC puts on screen when they do their annual 3-minute segment on precious metals before cutting to a commercial for an online brokerage. 150 million ounces. That is a big number. But it is roughly half of what the internal assessment projects for the cumulative gap by 2026. And the Silver Institute number is for 1 year. The 300 million ounce figure is the cumulative total that accounts for the compounding effect of rising demand against declining supply across multiple years. So why is the public number so much lower than the private number? Because the public number uses demand estimates that have been systematically lowballed for 3 consecutive years, and I can prove it. In 2022, the Silver Institute projected industrial demand for 2023 would be 540 million ounces. The actual number came in at 632 million. They missed by 92 million ounces. That is a 17% underestimate. In 2023, they projected industrial demand for 2024 would be 620 million ounces. The actual number came in at 680 million. They missed by 60 million ounces. A 10% underestimate. 2 consecutive years of massive undercounting in the same direction. These are not random errors. Random errors go both ways. These are systematic undercounts that always skew in the same direction. They always underestimate demand. They always make the deficit look smaller than it actually is. The question is why? And the answer is sitting right there on the Silver Institute's website. If you look at their board of directors and their funding sources, the Silver Institute is funded by the mining companies and the bullion banks. The entities that benefit from an orderly, calm, non-panicked silver market are the same entities that fund the research that tells you the market is orderly, calm, and non-panicked. This is not a conspiracy theory. This is a structural conflict of interest published in plain sight. The referees are being paid by the players, and every year the referees miss calls in the same direction. The internal report I have seen does not have this conflict. It was commissioned by consumers, not producers. Its incentive structure is the opposite. Industrial buyers do not benefit from a calm market. They benefit from accurate data because they need to plan procurement years in advance. If the data says there is a 300 million ounce shortfall coming, they need to know now so they can secure supply before it is gone. Their survival depends on the truth. The Silver Institute's funding depends on the comfortable fiction. So when the mainstream analysts go on Bloomberg and say the silver deficit is manageable, when they say recycling will fill the gap, when they say new mines are coming online, when they say demand will moderate, they are citing data from an institution that has underestimated demand by double digits for 2 years running and is funded by entities with a direct financial interest in keeping the price suppressed. They are not lying to you because they are evil. They are lying to you because the system they operate within is structurally incapable of telling the truth. The truth is too dangerous. If the market understood that 300 million ounces of physical silver will not exist by 2026, the price would reprogram overnight. The COMEX would face a delivery crisis. The ETFs would face a redemption crisis. And the banks sitting on short positions would face a solvency crisis. So the truth gets buried. It gets buried in private reports distributed under NDA to industrial clients. It gets buried behind paywalls and confidentiality agreements. And the public gets the sanitized version, the version that says everything is fine, the version that lets the paper market continue to function as if there are infinite ounces available for delivery, when the physical reality is that the vaults are hemorrhaging metal at a rate that will exhaust them within 18 months. Let me give you the one line that dismantles every bearish argument you will hear from now until the day the shortage becomes front-page news. Write it down, memorize it, use it. You cannot print a silver atom. You can print a futures contract. You can print an ETF share. You can print a bank research note with a $38 price target. But you cannot print element number 47. It is forged in the cores of dying stars. It arrives on the crust of this planet through supernovae that occurred billions of years before any bank was chartered. And we have already mined the easy deposits. The mainstream will tell you recycling solves the problem. Let me address that directly because it is the most frequently cited counterargument and it is the most mathematically bankrupt. Global silver recycling contributes approximately 180 million ounces per year. That number has been essentially flat for a decade. It has not grown because the economics of silver recycling are brutal. Most recycled silver comes from old photographic film, electronic waste, and industrial scrap. The collection infrastructure is fragmented. The refining process is energy intensive, and the yield per unit of input material is declining because modern electronics use thinner and thinner layers of silver that are increasingly difficult to recover. But here is the critical point. Even if you magically doubled silver recycling overnight, which is physically impossible, but let us pretend, you would add 180 million ounces to the supply. The deficit would still be 120 million ounces. Doubling the entire global recycling infrastructure does not solve the problem. It merely makes the problem slightly less catastrophic. Recycling is a band-aid on a gunshot wound. The mainstream will tell you new mines are coming. I already addressed this. There's not a single major primary silver mine under construction that produces before 2028. The pipeline is not delayed. The pipeline does not exist. The geological discovery rate for major silver deposits has collapsed. The grade of existing mines is declining, meaning you have to move more rock to get the same ounces. The all-in sustaining cost for primary silver producers has risen above $25 an ounce. At current prices, margins are healthy. But healthy margins today do not produce ounces tomorrow. They produce feasibility studies and permitting applications that will take a decade to convert into metal. The mainstream will tell you demand will moderate. They will say the solar industry is overbuilt. They will say EV adoption is slowing. They will say the energy transition is losing political momentum. Every single one of these claims is contradicted by the capital expenditure data from the industries themselves. Solar manufacturers are building new gigafactories at the fastest pace in history. Battery plants are being constructed on every continent. The U.S. Department of Defense just classified 17 minerals as critical to national security. Silver is on the list. Demand is not moderating. Demand is accelerating into a supply wall. And the consultants who prepared this report know it because their clients are the ones building the factories. Now we have to talk about what happens when 300 million ounces of physical silver that the market needs simply do not materialize. Because this is not a problem that stays contained in the silver market. Silver is not an isolated commodity, trading in its own vacuum. It is embedded in the supply chain of every major growth industry on the planet. When silver becomes unavailable, the contagion does not spread through the banking system first. It spreads through the industrial economy. Start with solar. If solar panel manufacturers cannot secure silver, production lines shut down. If production lines shut down, solar installations slow. If solar installations slow, countries miss their renewable energy targets. If countries miss their targets, they face energy shortfalls. Energy shortfalls drive electricity prices higher. Higher electricity prices feed inflation. Inflation forces the central bank to choose between rate hikes that crush the economy and rate cuts that crush the currency. Every link in this chain is already strained. A silver shortage does not create the crisis. It detonates the crisis that is already loaded and waiting. Move to defense. If defense contractors cannot get silver, weapons production slows. In a world where global conflict is escalating on multiple fronts, a slowdown in weapons production is a national security emergency. The U.S. government has the legal authority under the Defense Production Act to commandeer private silver stockpiles for military use. They have exercised this authority before with other strategic materials. If they exercise it for silver, the commercial market would see its available supply shrink overnight. The price would not double. It would go to a number that has no historical reference point. Move to semiconductors. Every advanced chip contains silver in its bonding wires and thermal interface materials. The semiconductor industry is already dealing with supply chain fragility from the chip shortage of 2021 to 2023. A silver constraint would reopen those wounds at a time when the world is building AI data centers that consume chips at unprecedented rates. NVIDIA does not care if silver costs $30 or $300. They need the chips. The chips need the silver. The cost is irrelevant. This is the daisy chain that the financial analysts refuse to model, because modeling it honestly would produce a price target that would get them fired. You cannot publish a silver price target of $200 at a major bank without your compliance department having a seizure. So they publish 38. They publish 45. They publish numbers that are consistent with the polite fiction that supply and demand will balance at a price that does not break anything. But the physics does not care about compliance departments. The physics says 300 million ounces will not exist. And when physics and finance disagree, physics wins. Every single time, without exception, throughout all of human history. Remember 1973. The world ran into a physical constraint on oil. OPEC cut production. The price did not adjust gently. It quadrupled in 12 months. The entire global economy restructured around the new reality. Governments fell, currencies collapsed. The geopolitical map was redrawn, and oil had substitutes. You could burn coal. You could build nuclear plants. You could conserve. Silver in a solar panel has no substitute. The coming repricing will make 1973 look like a market correction. Remember, 2021, the world ran into a physical constraint on semiconductors. Chip lead times stretched to 52 weeks. Car manufacturers shut down production lines. Prices for used cars doubled. Inflation spiked. The Fed was forced to pivot from dovish to hawkish in a matter of months. And that was a shortage of manufactured components that could be resolved by building new fabs. A shortage of a mined element cannot be resolved by building anything. You have to find it in the ground. You have to dig it out. And the ground is not cooperating. The historical pattern is identical every time a strategic commodity enters a structural shortage. Denial, then slow price appreciation, then a sudden violent repricing that overshoots to the upside by a factor of 3 to 5 times what any mainstream forecast predicted. We are currently in phase 2, the slow appreciation. The denial is fading, but the repricing has not yet begun. The 300 million ounce gap is the trigger for phase 3. And this brings us to the mechanism by which the shortage translates into price. Because you need to understand that the price of silver is not set by supply and demand in a physical marketplace. The price of silver is set on the COMEX futures exchange, where paper contracts, representing silver that may or may not exist, trade in volumes that dwarf the entire physical market by a factor of 100. In a normal market, the paper price and the physical price stay roughly aligned because arbitrageurs can buy physical metal and deliver it into the futures market to capture any discrepancy. But when the physical metal runs out, when the vaults are empty, when 300 million ounces of demand cannot be filled, the arbitrage breaks. The paper price becomes a fiction. The physical price becomes the only reality, and the gap between them becomes the measure of how broken the system has become. We're already seeing the early fractures. Dealer premiums on physical silver are averaging $4 to $6 over spot for standard bullion products. For popular sovereign coins, the premium is $8 to $12. A year ago, those premiums were $2 to $3. The physical market is already telling you that the paper price is wrong. The premium is the market's whisper. When the shortage becomes acute, that whisper becomes a scream. Now the Fed and the Treasury and the CFTC all know this is coming. They have access to the same supply chain data I just showed you. They have access to better data. They have classified briefings from the Department of Energy and the Department of Defense that outline the strategic implications of a silver shortage on national security and the energy transition. They know. So why are they not doing anything? Because doing something would mean admitting the problem. Admitting the problem would mean acknowledging that the price must rise dramatically. Acknowledging the price must rise would mean admitting that the bullion banks holding massive short positions on the COMEX are going to face catastrophic losses. Admitting catastrophic bank losses would trigger the same systemic risk conversation that led to the bailouts in 2008. They are choosing to manage the narrative rather than manage the shortage. They are choosing to let the clock run down and deal with the crisis when it arrives rather than prevent it. Because preventing it would require letting the price rise now, which would bankrupt the shorts now, which would require a bailout now. And nobody in Washington wants to explain to the American public why they are bailing out banks that made bad bets on a metal they told you was worthless. So they kick the can. They let the vaults drain. They let the Silver Institute publish its undercounted numbers. They let the analysts go on television and say everything is fine. And they hope that somehow magically the laws of physics will bend to accommodate the political calendar. They will not. The laws of physics have never bent for anyone. Not for kings, not for emperors, not for central bankers. 300 million ounces of silver will not exist, and no amount of paper, no amount of policy, no amount of wishful thinking will create them. This is the self-reinforcing trap, and I need you to see it clearly because once you understand this mechanism, you will never look at the silver price the same way again. The shortage drives prices higher. Higher prices increase the unrealized losses on the bank's short positions. The losses force the banks to post more margin. Posting more margin drains their liquidity. Drained liquidity forces them to the Fed's emergency facilities. The Fed provides emergency cash by printing dollars. Printing dollars devalues the currency. A devalued currency makes silver more expensive in dollar terms. More expensive, silver makes the shortage worse because industrial users accelerate their purchases to lock in supply before prices go even higher. Do you see the loop? Every intervention makes the problem worse. Every dollar printed to save the banks accelerates the currency debasement that drives the price higher. Every attempt to suppress the paper price widens the gap between paper and physical, which destroys confidence in the paper market, and drives more buyers into the physical market, which drains the vaults faster. They are trying to put out a fire by spraying it with kerosene. The kerosene is dollars, and there is no fire department coming because the fire department is the one holding the kerosene. The Fed cannot solve a physical shortage by printing money. Printing money is the only tool they have. Therefore, the Fed cannot solve this problem. It can only make it worse while pretending to make it better. And every day they pretend, the deficit grows. And every day the deficit grows, the eventual repricing becomes more violent. They cannot stop printing because the banks will fail. They cannot keep printing because the currency will fail. Both paths lead to the same destination, dramatically higher silver prices. The only variable is the timeline and the level of chaos. The market already senses this. The smart money, the commodity trading advisors, the macro hedge funds, the sovereign wealth funds, they are reading the same supply data I am showing you. They are doing the same math, and they are positioning accordingly. Look at the commitment of traders' data. The managed money category has increased its net long position in silver futures by 40% in the last 3 months. These are professional speculators with research budgets that exceed the GDP of small countries. They are not buying silver because they like shiny things. They are buying silver because their models are telling them the same thing this report tells me. The supply is not there. The deficit is real, and the repricing is coming. Now, look at what is happening in the physical market. Central banks that have never held silver reserves are quietly building positions through intermediaries. India imported over 100 million ounces of physical silver last year, nearly double the prior year. Chinese imports through Hong Kong have surged. The Shanghai premium over London spot has been persistently positive for months, which tells you that Eastern buyers are willing to overpay because they cannot source enough metal through normal channels. Do you think Beijing is not reading this data? Do you think the People's Bank of China does not have access to supply chain assessments that are identical or superior to the one I just described? They see the 300 million ounce gap. They see the Western vaults draining. And they are doing exactly what any rational strategic actor would do. They are securing physical supply before the shortage becomes common knowledge. Every ounce that moves from London to Shanghai is an ounce that will never return. It is absorbed into the Eastern financial system permanently. It is melted into different bar specifications. It is stored in vaults that do not report to Western exchanges. It has gone from the available supply pool that backs the COMEX and the LBMA paper markets. And with every ounce that leaves, the remaining float becomes thinner, the available inventory becomes smaller, the margin for error shrinks to zero. China is not doing this by accident. They are not buying silver because they have money to burn. They are doing it because they understand a fundamental principle that the Western financial establishment has forgotten. The nation that controls the strategic commodities controls the future. And silver is the most strategic commodity of the 21st century because it sits at the intersection of energy, technology, and defense. Without it, you cannot build a solar panel. You cannot build an EV. You cannot build a missile. You cannot build the future. This is financial warfare, and the United States is losing. Not because it lacks the dollars to buy silver, but because it lacks the silver to back the dollars. The 300 million ounce gap is not just a supply chain statistic. It is a geopolitical vulnerability. It is the soft underbelly of American industrial capacity. And every ounce that flows east is another inch of strategic ground surrendered. So what do you do with this information? How do you position yourself when you now know that the most comprehensive internal supply chain assessment in the silver market has concluded that 300 million ounces of physical silver will simply not exist by the end of next year? First, understand the timeline and do not let short-term volatility distract you from the structural reality. The report models the acute phase of the shortage beginning in late 2025 and becoming critical by mid-2026. That gives you a window. But the window is closing because the smart money is already moving. Every week you wait is a week where inventory drawdowns continue and premiums widen. The spot price you see on your screen today may be the cheapest silver you will ever see again, not because of hype, because of arithmetic. Second, prioritize physical metal over paper claims. When a market enters a true physical shortage, the paper derivatives that are supposed to track the metal decouple violently. ETF shares trade at discounts to net asset value. Futures contracts get settled in cash instead of metal. Unallocated accounts become unsecured creditor claims against bankrupt counterparties. The only position that is immune to all of these risks is metal in your hand. Metal in your safe. Metal under your direct physical control. If you do not hold it, you do not own it. That is not a slogan. In the context of a 300 million ounce deficit, it is a survival strategy. Third, watch the COMEX registered inventory number. This is the single most important data point in the silver market right now. Registered inventory represents the metal that is available for delivery against futures contracts. When this number reaches zero, the exchange faces a binary choice. Default on delivery obligations and declare force majeure, or let the price rise to whatever level is necessary to attract metal into the vaults. Either outcome is catastrophically bullish for physical silver holders. Either outcome represents a complete repricing of the metal. We track this number every week on this channel. If you are not subscribed, you're flying blind into a storm. The risk right now is not that you buy too high. The risk is not that silver pulls back 10% and you feel foolish for a month. The risk is that you're sitting on cash when the registered inventory report prints zero and the price gaps $20 overnight, and every dealer on the internet switches their website to say out of stock. The risk is that you know the data, you understood the math, you saw the 300 million ounce gap, and you still did nothing because you were waiting for a dip that never came. That is the risk, and it is not hypothetical. It is the mathematically probable outcome of the trajectory we are on right now. Here is what I need you to understand at the deepest level. We are not living through a normal commodity cycle. We are not watching a temporary supply disruption that will resolve in a quarter or two. We are witnessing the beginning of a structural physical shortage in a strategic industrial metal that underpins the energy transition, the defense industrial base, and the global electronics supply chain simultaneously. This has never happened before. There is no historical template. There is no precedent to look back on and say, here is how it played out last time. The closest analog is the oil crisis of the 1970s, but silver is worse because oil had substitutes, and silver does not. The closest analog is the semiconductor shortage of 2021, but silver is worse because you can build a chip fab in 3 years, and you cannot build a silver mine in less than 13. We are in uncharted territory. And the map that the financial establishment is handing you, the map that says $38 is fair value and the deficit is manageable and recycling will save us, that map was drawn by people who have every incentive to keep you calm while they position themselves on the other side of the trade. Do not use their map. Use the data. The data says 300 million ounces will not exist. The data says the vaults are draining at an accelerating rate. The data says industrial demand is climbing a wall of structural growth that no policy change can reverse. The data says the mines are depleting and the pipeline is empty, and the timeline to bring new supply online is measured in decades, not quarters. The data is the map. And the map says the price of silver at current levels is not just undervalued, it is a historical anomaly. It is a mispricing so extreme that future generations will study it in textbooks and wonder how the entire market could have missed something so obvious. You are not going to miss it. You are here. You have the data. You have the understanding. You have the conviction that comes not from hype or emotion, but from reading the same report that the industrial procurement officers are reading and arriving at the same inescapable conclusion. The silver is running out. The math is settled. The only question left is whether you're positioned on the right side of the ledger when the world wakes up to what you already know. 300 million ounces. Gone. Not missing. Not hidden. Not in a vault somewhere waiting to be discovered. Gone. Consumed by an industrial machine that is growing faster than the earth can replenish the metal. The deficit is not a theory. It is a measurement. And measurements do not care about sentiment or price targets or sell-side research notes. You have the information now. What you do with it defines which side of the wealth transfer you stand on, not a transfer from one stock to another, not from one sector to another, a transfer from those who held paper promises to those who held the physical element that the world cannot function without. This is the market cipher. The signal has never been louder, the shortage has never been more documented, and the window has never been narrower. Subscribe if you're not already. Share this video with one person who still thinks silver is just a shiny rock. They need to see these numbers before the numbers become headlines. And once they become headlines, it will already be too late to act on them. I will see you in the next one. Stay sharp. The clock is ticking on 300 million ounces, and nobody is coming to refill the vaults.